You were maybe 8 years old, maybe 10. You were standing next to a parent, and the parent was standing at a window, and behind the window was a person in a particular kind of shirt who held something that belonged to your family and was deciding what to do with it. You did not have language for what you were watching, but you were watching. You were always watching. That is where it started. Not with a headline. Not with a financial crisis. Not with a term you would learn decades later in a news cycle that made your stomach tighten for reasons you could not immediately name. It started in a lobby. It started with marble and silence and a small book with numbers in it that your parent treated the way other people treated a photograph of someone they were afraid of losing. The passbook savings account. If you are Gen X, you probably remember one. A small rectangular booklet, slightly thicker than a birthday card, with columns of deposits and withdrawals printed in faded ink by a machine that sounded like it was performing surgery. Your parents kept it somewhere specific. A drawer, a fireproof box, a particular shelf that was not discussed but that everyone in the household understood was serious. That book was the physical representation of something your family had managed to hold on to. It was proof that the ground beneath you was solid. And then, slowly, it was not. The savings and loan crisis did not arrive like a storm. It arrived like a slow leak in a ceiling. First one institution, then another. Then the number became too large to picture. Over 1,000 savings and loan associations failed between 1986 and 1995. Over 1,000. The federal bailout cost somewhere between $120 and $130 billion of taxpayer money, which is a number that was almost impossible to hold in 1990 and remains almost impossible to hold now. The people who ran those institutions largely walked away. The people who trusted those institutions largely did not. You were between 11 and 25 years old when that was happening. Old enough to absorb it, not old enough to have the framework to process it into anything clean. So it did not become clean. It became texture. It became the way your family talked about money in lowered voices. It became the particular expression on a parent's face when a bill arrived. It became a background hum that you carried into adulthood without ever deciding to carry it. Here is what the research says about that age window. The experiences a person has between roughly 10 and 24 years old shape their financial psychology more durably than almost anything that comes later. The brain during those years is doing something specific. It is building templates, patterns of trust and threat, categories of safe and dangerous. The economists call this the formative years hypothesis. What it means in plain language is this: what you watched happen to money when you were young became the lens through which you would see money for the rest of your life. That is not a metaphor. That is a neurological architecture. Now layer 2. You graduated. Some of you into the early 90s recession, which meant a degree in one hand and a rejection letter in the other. Some of you into the brief, irrational warmth of the late 90s, which felt like finally exhaling, which felt like maybe the ground was solid after all. You got jobs. You opened accounts. You did what you were told to do. Mostly because the alternative was to opt out entirely, and that was not a real option. Only a fantasy you kept in the back of a drawer next to the passbook you still somehow had. The banks were different by then. Friendlier. The marble was being replaced with carpet. The teller windows were being replaced with open counters designed to feel like conversations. The fees were buried in documents written in a font size that required specific lighting and specific patience, and most people had neither. The financial services industry was consolidating at a rate that would have been alarming if anyone had been watching closely, which most people were not, because they were working. Because Gen X was working constantly and quietly and without the expectation that anyone was particularly interested in how it was going. Between 1990 and 2005, the number of commercial banks in the United States dropped by nearly half. Thousands of local institutions absorbed into larger ones. The people who knew your name, who remembered your parents, who understood that a late payment in December was probably Christmas and not a character flaw, those people and those institutions were being systematically replaced by systems, by automated voices, by customer service hold music that had been scientifically designed to be not quite annoying enough to make you hang up. You noticed. You may not have had a press release about it, but you noticed. Then 2008. If you want to understand why Gen X does not trust banks in a way that is not performative, not political, not aesthetic, if you want to understand the distrust that lives in the body rather than the talking points, you have to understand what 2008 felt like from inside a specific kind of house with a specific kind of mortgage, with children in rooms down the hall who did not know what was happening, and parents in the kitchen who were trying to hold their faces very still. You were between 33 and 48 years old. You were not watching this crisis from a distance. You were inside it. The institutions that had sold you financial products you did not fully understand, that had packaged risk into instruments nobody could properly explain, that had operated with the assumption that the government would catch them when they fell, those institutions were caught. You, in many cases, were not. The FDIC reports that over 300 banks failed between 2008 and 2012. Home values dropped by an average of 30% nationally, with some markets losing half of their value or more. Retirement accounts that Gen X had spent years funding evaporated by 30 to 50% in months. And then, over the following years, the interest rates on savings accounts were reduced to something so close to zero that keeping money in a bank account felt less like a financial strategy and more like a courtesy you were extending to an institution that had not earned it. The distrust was never irrational. That is what the title is quietly saying and what the data quietly confirms. Here is the part nobody talks about. The distrust became identity. Not loudly, not as a bumper sticker or a talking point, but in the specific way that a learned response, repeated enough times across enough years, stops feeling like a response and starts feeling like a personality. Gen X savers, those who saved it all, and the research suggests a meaningful portion did not, tended toward the tangible. Cash, real estate, gold in some cases, which their parents had also kept somewhere specific. Things they could see and touch and remove from a system if the system once again demonstrated that removal was the only sensible response. A 2019 survey by the American Psychological Association found that Gen X reported higher financial stress than any other living generation, including millennials carrying student debt and baby boomers approaching retirement. Higher. The generation that was supposed to be cynically fine, the generation that prided itself on managing alone, was quietly carrying more financial anxiety than anyone around them, which makes complete sense if you understand that anxiety is not produced by weakness. It is produced by history. The ground moved under them at 10. It moved under them at 22. It moved under them at 38. The logical response to ground that keeps moving is not to become careless about where you stand. It is to stand very carefully and to trust the ground only as far as you can afford to have it move again. That is not cynicism. That is earned caution. There is a difference, even though from the outside they can look identical. And the banks, for their part, did not stop giving reasons. The overdraft fee industry generated approximately $33 billion in revenue in 2023. The majority of those fees were paid by people who could least afford to pay them. The fine print continued to lengthen. The branch networks continued to shrink. The algorithms continued to make decisions about creditworthiness that no human could fully explain, and that often replicated the biases of the humans who had built them. The marble was gone, but the geometry remained. You were right to be cautious. You were right in the lobby when you were 8, watching your parents' face at the window, not knowing what you were watching, but knowing it mattered. You were right in the 90s, when the friendly carpeted banks turned out to be running the same calculations behind a warmer aesthetic. You were right in 2008, when the thing that was supposed to be stable demonstrated, with extraordinary clarity, that stability had always been the pitch, not the product. The distrust was never entirely wrong. The title says so. The data says so. The specific quiet of a kitchen in 2008 says so. What it cost you is a different question, and it is a real one. A generation that opted partially out of the financial system still had to live inside an economy built around that system, still had to retire inside it, still had to fund children's educations inside it, still had to grow wealth inside it, or fall behind in ways that compounded quietly for decades. The caution was earned. The caution also had a price. Both of those things are true at the same time. That is the room the distrust was built in, and most of you have been living in it ever since. If this particular kind of history is something you think about, there is probably more on this channel worth your time.